Hi, everyone. Welcome to the second quarter capital market review. We'll talk about certain aspects of the economy that affect second quarter 2023, right up through June 30th. This has been an interesting market, one of the most complicated and perhaps stressful markets that I've ever experienced in the 40 years that I've been doing this. There's a lot of swirling ideas, information, economic data. We got the Fed, the Treasury at some points at odds, doing things a little bit differently, restricting, throwing money into the market to save banks. And there's concern over where all this ends. And then you've got a stock market that is rallying and soon to see some of the best half-year performance numbers ever recorded. And that's somewhat misleading as well, because the market is not necessarily the economy, and the economy is not necessarily the market. But at some point, they do get together. At some point, there is a reversion to the mean. So it's important to kind of take a look at where we are in terms of the economy. As we do every quarter, we come up with a theme. And I think the best theme we could come up with is this phrase, waiting for Godot. So the theme is are we waiting for Godot, or is this waiting for Godot, or isn't it? Or are we waiting for Godot, or aren't we? And the phrase refers to waiting for something that has a probability of never to come to fruition. Because that's the belief right now. Everything is fine. We're going to avoid a recession. It's going to be worst case, a soft landing. We've even heard people say, hey, it's going to be a no landing situation. Well, let's get into some of this just to see exactly where we are. And we do this so you've got a better understanding of what we're thinking, which is why the portfolio looks the way it is and what guides us in terms of the decisions we effectively are making. We'll dig into some data, because the economy matters. We'll talk about jobs and inflation and interest rates, as we typically do. We do all this because we want to answer a couple of important questions. Where are we right now? Is the recession behind us? Good times ahead? Or is the recession still ahead of us? And what do we need to do to better protect ourselves for that? For us, we got to get two things right, and that drives the whole allocation equation. Where are we in terms of this economic cycle? And what's the Fed up to? Is the Fed our friend or foe? Are they loosening or tightening? For a long time prior to COVID, about 13 years, interest rates were nearly zero. For that full period of time, the Fed was our friend. Interest rates at zero, quantitative easing, risk on. But in the last 18 months, it's been an entirely different story. And it's important to understand the Fed because they're somewhat omnipotent. If they want to take a perfectly good economy and stall it, they can do that. If they want to take a really sickly economy and give it a booster shot, they can do that too. So our agenda is it looks long, but we go through these fairly quickly. Inflation, we'll talk about interest rates, talk about the labor market, which we think is really important because right now everybody thinks we can't see a recession because look at how strong labor is. We'll talk about consumers, kind of where they are, what that looks like, because that's 70% of our economy. And then we'll talk about the leading economic indicators and why it's important to pay attention to those and what they're telling us today about what may very well happen in the near future. And then we'll talk about the market today from the perspective of perhaps distraction. So let's get right into this. Inflation. Hey, the good news is inflation is coming down. Both the headline and the core number are coming down, certainly from their peak last summer. The headline number always comes down a bit quicker. It is also more volatile. Most, I would say, of the drop that we've seen is directly related to energy. And unfortunately, the energy numbers can go up, down, or sideways. For example, month to date, oil prices are up 5%. The month ended now, that component of the headline number may very well cause headline to actually increase a bit. I think because of that, and the fact that the core number is barely off of where we were a year ago, it's down, but not substantially, is one of the reasons that the Fed more than likely will raise again next week, and why you've had a lot of Fed presidents talk about how the job's not done, how we may have more than one hike to go. As we move in through the summer and then the winter months, oil prices generally rise. The only time that they would severely drop from here is if we went into a really severe recession shortly. So be careful what you wish for. Are these employment numbers coming down because demand is beginning to crumble, which is a telltale sign of a recession? Or is there some other mechanism that's causing the inflation numbers to drop? I think what we're really dealing with is a change in story. The CPI issue, the high inflation issue, was so 2022. Now we should really be focused on what damage will there be, perhaps, as a result of all those rate hikes that we've had. To get inflation to where it is today, we had to raise rates. Inflation is not over. We can't bring rates down anytime soon, but all the cumulative effect of all those rate hikes will at some point bite the economy. It'll slow things down. And any of the slowdown we've had already may very well be just based on a few of the very early rate hikes. So this lag effect, which often is 12 to 16 months, 14 on average, will have an effect on the economy and have effect on prices of risk assets. Speaking of interest rates, let's take a quick look at where the Fed is. This chart shows all the FOMC or Fed fund rate moves over the last 30 years. And you'll see how they stair step up and they come down pretty quickly, stair step up, come down pretty quickly. If you look at the size of the rate hikes that we've had off of a zero base, this rate hike session has been pretty dramatic. We've raised rates over 5% off of a 0% base. That is larger than anything we've done in the last 30 years. More importantly, we've done it over a very short period of time. If you want to look at how long it's been since we raised rates this high and did it over this short a period of time, you'd have to go all the way back to 1980. Now, I was still an undergrad in 1980, graduated in 81, and I remember that period of time. Paul Volcker raised rates significantly to try to stop inflation. We had two recessions back to back because of the increase in rates that we saw back then. This rate hike is substantial. The fact that it's off of a zero base is also substantial. In fact, going from 0 to 5% is at least a 500% increase. That's vastly more impactful and problematic than going from 5 to 10, which is a double of rates. And the fact that it happened so quickly has its own set of issues and concerns. The other issue about this lag or bite has to do with the fact that the economy is really quite levered today. If we look at the chart to the right at the bottom, which shows net debt, our national debt, and our national debt as a percentage of GDP, that'd be like your income relative to your mortgage, let's say. In 1980, the last time they raised rates as high as they have, as short a period of time as they have, our debt level relative to GDP was barely 30%. Today, it's well in excess of 100, probably 110. So I would argue that a 5% increase in interest rates on an economy that is levered 110% or more has much greater negative impact than a 5% increase in interest rates in an economy that has a 30% debt level. And you're beginning to see that in commercial mortgages. You're beginning to see that in lending. And all of these things are lagging indicators. It takes a while. Another usually telltale sign of a recession is what is referred to as an inverted yield curve. So this shows the yield curve of the US Treasury, what you could get to borrow money at 3 months, what you could get to borrow money at 3 years, 10 years, 20, and then 30. At the bottom of the page, that's a reflection of a normal yield curve. Interest rates at the low end, 3 months, 1 year, are much, much lower than the rates in the out years, 10, 20, 30, which you would expect. Banks borrow money at the low rates and they lend money at the high rates. There's a profit incentive to do so. If you look at the charts at the top of the page, those reflect an inverted yield curve, almost a mirror image. Rates at the short end, the rates that the bank borrows from the Fed, are well in excess of 5%. And then they lend money out on mortgages or credit cards or other things at generally somewhat of a lower rate, base rate. And then you add a surcharge for credit. So, mortgage rates now are just under 7, let's say. But the point is, there's far less profit incentive. And as a result, it affects banks' willingness to lend or the ability to lend profitably. By the way, this yield curve inverted in August. We're going on a year. It's one of the longest periods of time ever that we've had an inverted yield curve. An inverted yield curve is a pretty strong predictor. Predicting, I think it's 12 of the last 16, 10 of the last 10, or something to that effect. And the other thing is, anytime the Federal Reserve continues to raise rates into an inverted yield curve, it always ends in a recession 100% of the time. And the Fed has continued to raise rates since August. Labor is important because that has everything to do with the employment rate. And we've heard that the economy is way too strong. We won't go into a recession because the unemployment rate is so low. Well, it has been. Unemployment, or the employment number, effectively is a lagging indicator. It's one of the last things to drop, one of the last things to weaken. And the reason is the economy, it's been kind of difficult to hire. And employers want to hang on to good employees for as long as they can. So they cut other things, they adjust pricing, they look for other economies of scale. But as losses continue to mount up, they finally acquiesce and have to lay off. We are beginning to see at just the fringes some weakness in employment. Job openings numbers, while they're still strong, are beginning to weaken, as referenced by the first slide. If you look at the second two slides on the right-hand side, the quit rate, that's people quitting jobs before they have another job lined up. Those are dropping. 6-8 months ago, people were quitting jobs and getting hired back pretty regularly. And then we're beginning to see layoffs starting to bounce a bit off the bottom, still very low and certainly below trend to date. Some of this is also some confusion and complications, as a result of COVID and a lot of money being pumped in and people working remotely as well. All of that has really kind of changed somewhat the complexity of employment. I've often heard, as recently as this week, the argument that there's no way we'll go into a recession with the employment rates as high as they are today. You just can't go into a recession when the employment rates are as high and the unemployment rates are as low. In fact, I heard this from somebody who should know better. Multiple PhDs from Stanford, ran the Federal Reserve, had Jerome Powell's job, and now runs the Treasury. She should know better. This chart shows the last 9 recessions. Each one of those boxes represents that period of time where a recession was prevalent. The gray shaded area represents the time in and out of the recession. The green lines represent the S&P 500. And you'll notice that they typically take on some kind of a V shape. Generally, the market bottoms out well into or shortly after the recession. The argument that we're not going into a recession, the market's already bottomed out last year, doesn't hold the test of time. The vertical black line represents the bottom of the S&P. But the one I want you to focus on is that purple line, which is the unemployment rate. Look at any of those recessions. Look at all the recessions. The unemployment rate is typically at its lowest point registered in and around the beginning of a recession. And then during the recession, it ramps up. And the unemployment rate generally continues to ramp up a bit just beyond the recession. So this idea that we can't see it happening because the unemployment rate is still so low just doesn't bear the test of time. Consumers drive the economy. They're 70% of it. And as the consumers go, so goes the economy. And one of the reasons this lag has been so frustrating is because consumers have been so strong. First, they were spending a ton of money on stuff during COVID, Pelotons, whatever Amazon could deliver. And now we're getting revenge spending cooped up for several years. I want to travel, I want a vacation, whatever the case might be. Add to that this remote working, and people are kind of changing the lifestyle as well. And that was all well and good. And to a large degree, it was financed by jobs and income. And lately, it's been financed by savings. Personal savings rate spiked in 2000 or so to a high that we haven't seen in years. And part of that had everything to do with checks being sent to Americans. On the right-hand side, you'll see excess savings, that's accumulated savings. And at one point, going into 2022, it peaked at 2.1 trillion. Milton Friedman, famed economist, was a monetarist. Inflation is all about money supply. It's interesting that we started having inflation problems in 21 and then into 22 as the amount of cash in the system continued to rise. Far too much money chasing too few goods. But look at where we are now in terms of excess savings. It has gone down from 2.1 trillion to about 0.4 trillion. And at this rate, it'll go to zero in a matter of months. So the idea is what happens then to consumer spending? And when does that hit? Is that August? Is that September? Is that October? But it certainly looks like it will. What's happening is consumers are still spending a bit more than they probably should because we're seeing consumer credit outstanding starting to rise. And we're seeing it rise because of the onboarding of new credit cards. We're also seeing a rise in HELOCs. People are continuing to spend by tapping even at a 7-8% rate because they feel like it's temporary. They can get through it and pay it back over the course of the next couple of years. This does have ramifications, and we're already seeing those. If you look at the far right-hand side, first chart on the top, household debt service, the ratio to income, it's beginning to rise pretty significantly from just over 8 to almost 10. It's not as high as it was in 07, but it's moving, and we're in the early stages of this decay. The chart at the bottom is showing what is typically expected. You're seeing delinquencies rising significantly in auto loans and credit cards, almost 7% delinquencies, people that are over 30 days late with cars, purchase and lease, and credit cards about 6.5%. The only one that The only thing that looks really good here is student loans. And that's because at this point, nobody has been required to make a payment for several years. That's changing later this summer into early fall. And that number usually goes up pretty quickly. In fact, if we look at the upswing in defaults or delinquencies today, it doesn't look that dissimilar from where we were going into 08. In 07 and into 08, we saw an upswing there as well. The leading economic indicators, those that tend to predict recessions, are rolling over. There are three types of indicators that we are concerned with. Leading, that are kind of ahead and telegraph things to watch out for. Coincident indicators, which are more present. And then lagging indicators. For example, the employment numbers that we talked about before are lagging. They're usually the last shoe to drop. The first shoe is typically housing, and then corporate orders. You see that with PMI, manufacturing, et cetera. And then you see that in terms of profits and profit misses, and profits have been down about 8% this quarter and 8% the quarter before, but we really haven't seen the big drop in profits yet because, again, a lot of the lagging indicators have yet to bite. This chart's a little confusing, a little bit busy. Those gray bars you see that are vertical represent 3 of the last recessions, starting left to right. That's the recession following the dot-com. The middle is the Great Recession or financial crisis. And that little sliver that you see lasted about 2 months. And it was really the COVID-induced recession. Anything above 0 is still positive in spite of the fact that the slope is negative. The gray line that you see running across the page is year-over-year change in GDP. And you'll see where it peaked just about 18 months ago and has come down rapidly. In fact, the drop in GDP is the greatest drop over a shorter period of time that we've seen in the last 20 years, with the exception of COVID. It's progressing quicker than the financial crisis. It's progressing quicker than the recession we saw in 01. The thing that I look at, that I spend time on, is year-over-year change in leading economic indicators. And there are about 20 of those. By the way, the stock market and stock market performance happens to be one of them. And obviously, performance in the stock market year-to-date has been pretty great. So imagine what the numbers would look like, or what the chart would look like, if we didn't have that to help right the ship. Those numbers are pretty ugly. The chart is pretty ugly. I can't understand why people say no recession because everything looks great. Market's up, employment's up. These are all either coincidental or lagging indicators. In fact, if you go back through time and you see any period of time when you've seen a drop of minus 4% or more in leading economic indicators, it's recession time, folks. We get a recession. We are now about -8. In fact, if you go back and look at when the chart of leading economic indicators look like it does now, at the beginning of the chart, that would be the 01 recession. That was a 56% drop, or 53% drop, I think, in the S&P. The middle one was a 56% drop. And then the last one, COVID, was a 38% drop. And by the way, it probably would have been a whole lot worse, but the government immediately pumped in $10 trillion. And I don't think we'll see the same kind of pump in terms of dollars because of this inflationary issue that we have. So this is problematic. This is not a soft landing scenario. A soft landing would have been what we saw in 2011 and 12, and what we would have seen in 2015, 16. That is what, by definition, a soft landing is. The fact that we're -8 is anything but. And in fact, if you look at recession signaling, not officially a recession, clearly we've passed that. And we passed that just as the leading indicators were breaking -4. Another way of looking at this is this chart, which dissects some of the indicators. Some are leading, some are coincidental, some are lagging, but they're all weakening. In fact, there hasn't been in the last 18 months a single component of this that has improved month over month. They all get weaker or stay and then weaken. If you consider how far we've gone, because back in the fall of 2021, they were all green. Everything was fine. Interest rates were zero. Government didn't believe in inflation. They were using quantitative easing. It was risk on, and it was reflected in many of our IRA accounts. Today, it's very conservative, and compared to performance of the market, might look foolishly conservative. But the data doesn't lie. It never does. Every recession looks like and kind of starts this way. And the numbers are weakening. Even those things that were relatively strong, like jobless claims, have gone from, in March, a green arrow, improving, healthy, to weakening. The slope is negative, a slower rate of growth. Job sentiment, quit rate, has gone from slower to negative. And the other thing, which is usually a leading economic indicator, and I think it's been a bit skewed because of supply chain issues over the last couple of years, is trucking. It's beginning to weaken. In fact, we're seeing layoffs now within truck driving, the trucking industry, I should say, first since 1998 or so. And some of the strikes that are in discussions like UPS won't help the situation either. Yellow Freight, large overland freight company, is potentially filing bankruptcy. So trucking isn't really healthy now. Will it improve into next year and beyond? Absolutely. But it certainly is a typically leading indicator. The market, good, bad, indifferent, isn't an indicator. You can't look at the market and say, oh, wow, S&P's up, everything must be rosy. S&P's down, everything must be horrible. This market has been somewhat hijacked. I'd mentioned not that long ago that some of the things that I see kind of rhyme with where we were in 2008 or leading up to the financial crisis. Not saying we're going to get one, but I am saying recessions build just like that. Also, some of what I'm seeing today rhymes a bit with 1999, 1998, and then the dot-com bubble. Economic indicators were rolling over just like they do today, and the market was going higher. Everybody in 1999 was in love with the idea of the internet and all that the internet could provide. In fact, back in 1999, the biggest 5 companies represented 19% of the S&P in terms of market cap. As they went, so went the market. Today, the 5 biggest tech companies, as of last week, now represent 23% of the index. And as they go, so has this market gone, but not an indication of economic health. Instead of being excited about the internet in 1999, we're excited about AI. And just like in 1999, the internet may not have been quite ready for prime time, and a lot of the advancements in productivity happened much, much later. I don't think the market or industry is quite ready for AI. It's not quite prime time either. Had you made the mistake and bought into the hype of the internet, the 5 biggest companies you would have bought or owned, or the mutual funds you had would have owned, would have been Microsoft, GE, Walmart, Cisco Systems, and Intel. And had you bought them in 1999 and held them long term because of the prospects of what the internet had to offer, you would have had to wait 15 years with Microsoft to get the share price back to what you paid for it. You would have had to wait 11 years with Walmart to do the same. And it would have taken nearly 20 years for Intel to get back to the price it was in 1999. Sadly, GE, you're still waiting, and it's a fraction of what you paid 24 years ago. And Cisco, while it's a very successful, much larger company, when you're paying 20, 30, 35 times sales, the company just can never grow into those expectations. And people are still waiting today to get their money out of Cisco. And they're a long way from making that happen. Today, the seven, and you can see the top five, in the aggregate, represent about an 80+% return this year. So you want to know why the market's up 14% or 15% and the NASDAQ's up 33? It's essentially because of these. In fact, the top five represent almost 50% of the NASDAQ 100. There's a lot of air in the market as a result of that. So I do these, as I said before, because we're concerned with providing the best service we can. We understand that most of our clients work 30+ years to accumulate money. You didn't sell a company. It's not a big liquidity event. The money came by hard work and denying savings. And it's important as we move toward retirement and in retirement, when we start using this money to support lifestyle, we need to be able to protect against big drops. While you could afford to ride the roller coaster while you were accumulating, had a job, working, and savings, that roller coaster will deny you spend. It will deny you experiences and can take many years to recoup. So we're a little bit more defensive than what we might have been had the leading indicators not proven to be as negative as they are, regardless of where the market is. So it's important to understand where we see ourselves. We think the recession is not behind us, it's ahead of us. And we clearly think the Fed, at least at this point, is still quite hawkish and tightening. And as I said before, the Fed is omnipotent. They will stall an economy. Inflation is coming down because the interest rate hikes are beginning to work, but they haven't come down enough that they can stop. And when the Fed stops, the cumulative effect of their hikes will linger on because they're not going to cut anytime soon. And if you wish for a cut, be careful what you wish for, because it may be directly a result of something breaking, like the economy or the credit market. So this is why we do what we do. Hey, we'd love to talk to friends and family. If there's anybody who you think would like to work with a firm like ours, who is concerned about this, as opposed to just comfortably sitting you in a roller coaster and waving to you as you leave the platform to ride this craziness called the market, then we'd love the opportunity. Please reach out by phone or by website. We use a pretty elegant process. Most of our clients are engineers or scientists, so they understand process. And hey, while you're at it, check out The Retirement Engineer. It's a podcast that's available wherever podcasts are available. Apple, Google, Spotify. We talk about all kinds of tactics, techniques, strategies to improve your retirement, to create what we like to refer to as a bigger, bolder retirement, which amounts to participating in the markets when they're good and being somewhat defensive when they're not, as opposed to just take the market as it comes. If you have any questions or comments about this or anything, reach out by phone, by website. With that in mind, I want to thank you, as always, for your trust and confidence over these years. If there's anything we can do for you or enhance your experience, let us know. Once again, thanks so much. Enjoy the rest of your summer, and we'll talk to you again very soon. Take care, folks.